For most of our lives, we were taught to treat the global financial system as something permanent, solid as bedrock. You go to work, check your bank balance, glance at the markets, and assume the numbers on the screen represent something real and durable. That assumption worked when the system was stable. It no longer does. Today, stress fractures are spreading through the foundation, and what we are witnessing is not a routine cycle or a temporary shock. It is a structural transition, one that history only produces once or twice in a lifetime. For decades, the playbook was simple and comforting. Trust the dollar. Buy the bonds. Let institutions handle the risk. Believe the narrative that the system is under control. But that playbook breaks down when key allies quietly reduce their exposure to U.S. debt without public explanation. It breaks down when confidence erodes not with a headline, but with silent, deliberate exits. These are not emotional decisions. They are calculated moves made by entities that see further down the road than the average investor ever will. At the same time, something even more telling is happening beneath the surface. The world's most advanced manufacturers, companies that run on precision, scale, and long-term planning, are no longer reacting to commodity prices alone. They are securing supply directly. They are locking in physical inputs because uninterrupted production matters more than short-term costs. When industrial leaders stop trusting markets to deliver what they need on demand, it signals a deeper problem than volatility. What we are seeing now is a decisive rotation away from paper assurances and toward physical reality. This is not speculation. It is behavior. It is capital moving, where trust still exists, into assets that cannot be printed, restructured, or politically negotiated away. Behind this shift is unresolved historical damage, strategic repositioning between nations, and a growing recognition that only tangible resources sustain real economy. This is not a story about panic. It is a story about preparation. And the men who understand the difference are the ones who tend to survive periods like this with their footing intact. To understand why China is accumulating gold at a pace rarely seen in modern history, you have to stop thinking in quarterly reports and start thinking in centuries. This is not a short-term trade. It is the continuation of a lesson learned the hard way. In the mid-19th century, China was the richest civilization on Earth in real terms, sitting on vast reserves of silver that underpinned its economy. What it did not have was the military power to defend that wealth. When Britain won the Opium Wars, China was forced to hand over roughly 21 million ounces of silver as reparations. That transfer of metal was more than a payment. It was a forced extraction of sovereignty. The consequences were devastating. Silver drained from the economy, inflation surged, internal stability collapsed, and China lost control over its monetary system for generations. This period, now known as the Century of Humiliation, is not abstract history inside China. It is institutional memory. The lesson was brutal and unmistakable. If another power controls the money you rely on, it ultimately controls your future. That memory explains what we are seeing today. China's sustained and often understated accumulation of gold is not about chasing returns or hedging inflation in the Western sense. It is about insulation. By adding hundreds of tons to its reserves year after year, frequently through channels outside the public balance sheet, including state-owned enterprises and strategic institutions, China is reducing its exposure to foreign currencies and limiting its vulnerability to external pressure. Gold, unlike reserves held in another nation's financial system, cannot be frozen, sanctioned, or politically redefined. This is financial defense, not portfolio management. Gold gives China optionality in a world where trust in the dollar system is no longer unconditional. It supports trade outside traditional settlement rails and underpins a parallel framework that does not require Western approval to function. When China buys gold, it is not making a bet. It is closing a historical loop. What you are witnessing is not speculation or symbolism. It is a nation that remembers exactly what happens when its wealth exists only at the mercy of others, and is determined never to repeat that mistake. On January 6, 2026, the U.S. Treasury market stopped behaving like a sanctuary and started looking like a crime scene. Japan, the largest foreign holder of American debt and one of Washington's most reliable allies, initiated a large-scale liquidation of roughly $1.20 trillion in U.S. Treasury. Official explanations rushed in, labeling it a routine currency operation. That framing is comforting. It is also misleading. What actually unfolded was not strategy. It was necessity. The Japanese yen has been under relentless pressure, losing close to half its value against the dollar in just a few short years. That kind of collapse doesn't stay confined to currency charts. It drives import costs through the roof, threatens energy security, and erodes domestic stability. Japan does not have the luxury of ideology when oil, food, and industrial inputs are priced in dollars. To prevent a full-blown currency crisis at home, they were forced to sell what they had in size, U.S. debt. Not because they wanted to, but because they had no other option left. That single act exposes a structural fault line in the global system. When America's closest ally is compelled to dump treasuries just to survive, it sends a signal no press release can suppress. The treasury market is no longer a universal safe haven. It is a pressure valve. And when Japan sells, it doesn't just move prices. It drains collateral from the global financial system, tightens liquidity, and forces yields higher across the board. This is how stress propagates quietly, mechanically, and then all at once. The Federal Reserve now finds itself boxed in. Allow yields to rise naturally, and the consequences are immediate. Housing buckles, refinancing freezes, and companies that only exist because money was cheap begin to fail in waves. Step in and buy the debt instead, and the damage shifts to the currency. Further dilution of the dollar and renewed inflation pressure for everyone holding cash. There is no clean exit from this position. Only trade-offs, all of them painful. This is not an attack by Japan. It is a warning shot fired by reality. A survival move that reveals how fragile the post-1945 financial order has become. When even allies are forced to choose between saving themselves and supporting the system is already in its final phase. While most investors remain distracted by the paper games played between banks and trading desks, a far more consequential shift is underway. One driven, not by speculation, but by survival. Big tech has entered the commodity markets, and it is operating under a completely different set of rules. Companies like Samsung have identified a hard constraint that no amount of financial engineering can solve: silver. It is the most electrically conductive and reflective metal known, and it is irreplaceable in modern manufacturing. Chips, smartphones, batteries, displays, none of them function at scale without it. For nearly 4 decades, silver prices were shaped largely by derivatives traded in New York and London, detached from physical supply. That era is ending. Today, price signals are being overwhelmed by industrial necessity. Tech manufacturers are confronting what can only be described as a conductivity shortage, a scenario where supply reliability matters more than price. When production lines depend on uninterrupted access to a single material, markets stop behaving like markets. Samsung is not acquiring silver to speculate, hedge inflation, or express a macro view. It is buying silver because without it, production stops. That distinction matters. This is inelastic demand in its purest form. Whether silver trades at $50, $100, or several $100s an ounce becomes secondary when the alternative is shutting down factories, missing product cycles, and losing market share permanently. These companies cannot wait for prices to normalize. They must secure metal at almost any cost. To do that, they are bypassing the exchanges entirely. Instead of competing for dwindling supply on public markets, they are going upstream, signing long-term offtake agreements directly with miners to lock in years of future production. In some cases, entire mines are effectively pre-sold before the metal ever reaches the open market. This creates a silent vacuum. Paper prices may appear calm, but physical silver is being pulled out of circulation and absorbed into private industrial stockpiles. What we are witnessing is not a squeeze driven by retail enthusiasm or hedge funds. It is the quiet privatization of the world's silver supply by entities that understand a basic truth. In a digital, electrified economy, silver is not a commodity. It is infrastructure. And once infrastructure disappears behind closed doors, it rarely comes back to the public market. The global race toward green energy has triggered a consequence few policymakers plan for, and even fewer are prepared to manage: a structural silver squeeze. Solar power is now the single largest industrial consumer of silver. And as renewable mandates accelerate, demand is no longer growing gradually. It is turning vertical. Next-generation solar technologies such as TOPCon and heterojunction cells require dramatically more silver paste per panel, in many cases 50 to 80% more than earlier design. Efficiency gains are being purchased with metal the world does not have in abundance. By 2026, solar manufacturing alone is projected to absorb close to half of annual global silver mine production. That figure matters because it exposes a hard physical limit. Silver supply cannot be scaled on command. Unlike oil or gas, silver is rarely mined on its own. It is largely a byproduct of gold, lead, and zinc extraction. Even sharp price increases do not translate into rapid production gains. There is no switch to flip, no reserve capacity waiting to be activated. The contradiction is stark. Governments that have legislated net zero targets have, in effect, mandated the accelerated consumption of a finite and irreplaceable metal. And once silver is used in a solar panel, it is not recycled in any meaningful timeframe. It is bonded into silicon and glass, mounted on rooftops and solar farms, and locked away for decades. From a supply perspective, that silver is gone. This is not a temporary imbalance. It is a permanent drawdown of above-ground stockpiles at a pace never before seen. We are consuming a strategic material to meet policy goals without securing the resource base required to sustain them. In practical terms, it is the equivalent of dismantling the structure of the house to keep it warm, solving today's energy problem by quietly undermining tomorrow's industrial foundation. The result is not just higher prices. It is a collision between political ambition and physical reality. And history has shown repeatedly that physical reality always wins. Just as the solar industry is quietly draining the global silver supply, a second demand shock is forming. One far more dangerous because almost no one is pricing it in yet. Solid-state batteries represent the black swan of the energy transition. They are widely viewed as the holy grail of electric vehicles, promising ranges approaching 600 miles and recharge times measured in minutes rather than hours. But behind the marketing gloss sits an uncomfortable physical reality that manufacturers rarely emphasize. The most effective solid-state battery designs rely on a layer of pure silver nanoparticles in the anode. This is not a marginal improvement or an optional component. It is a performance requirement. Current estimates indicate that a single solid-state electric vehicle battery could require anywhere from 50 to 100 grams of silver. That number may sound small until you scale it to industrial reality. At projected production levels of roughly 20 million electric vehicles per year, automotive silver demand alone begins to rival that of the entire global solar industry. This is where the math stops being theoretical. We are moving into an industrial pincer movement. Solar energy tightening supply from one side, electric vehicles tightening it from the other. Together, they leave virtually nothing available for traditional demand channels like jewelry, electronics buffering, or an investment-grade bullion. This is why behavior matters more than headlines. Companies like Samsung are not waiting for markets to adjust. They are securing mines, locking in long-term supply, and building refining capacity directly at the source. That is not speculation. It is contingency planning. They understand that a technological revolution fails instantly if it runs out of raw material. Once a precious metal crosses the line into critical infrastructure, once it becomes a battery metal, at that point, pricing is no longer driven by sentiment or cycles, but by necessity. And when necessity collides with scarcity, markets do not move gradually. They reset violently. This is how black swans emerge, not with a single headline, but with supply chains that quietly snap under pressure. In January 2026, the silver market exposed a contradiction that should not exist in a functioning system. Paper silver prices fell roughly 5% on technical trading, yet physical silver all but disappeared from dealer inventories. Shelves were empty. Delivery times stretched into months. This is not a coincidence. It is evidence of a widening fracture between Western electronic markets and the physical reality playing out elsewhere in the world. In the paper markets, price is often dictated by mechanics that have nothing to do with supply. Institutional banks are periodically forced to liquidate enormous positions due to index rebalancing and mandate-driven adjustment. Billions of dollars in contracts can be dumped into the market in a matter of hours, regardless of whether a single additional ounce of silver actually exists. This structural selling can push the quoted spot price lower, but it does nothing to create metal. It only creates the illusion of abundance. While trading desks in New York and London exchange digital claims on silver, buyers in Shanghai, and increasingly retail investors across the United States are confronting a very different reality. Standard 100-ounce bars are sold out, allocation is rationed, and delivery schedules are being quietly pushed back. The signal is coming through premiums. The extra cost required to secure physical metal has surged to nearly 3 times historical norms, a clear market admission that supply is constrained. This divergence exposes a hard truth. The quoted spot price has drifted into fiction. It is a number generated by derivatives, not a reflection of how difficult it is to obtain the real asset. In environments like this, price becomes less informative than availability. The market is telling you in plain terms that promises are plentiful and metal is not. For anyone concerned with genuine wealth preservation, this is the line that matters. Screen prices can be adjusted. Contracts can be rolled. But physical ounces either exist in your possession or they do not. In periods of systemic stress, that distinction stops being philosophical and starts being decisive. The world order that emerged after World War II, built on free trade, multilateral institutions, and the unchallenged dominance of the US dollar, is not slowly evolving. It is being dismantled in real time. The assumptions that governed global markets for nearly 80 years are breaking down, replaced by a harsher reality defined by resource nationalism and renewed great power competition. This shift explains behavior that would have been unthinkable a generation ago. The United States is pulling back from dozens of international frameworks, while simultaneously signaling a massive escalation in defense spending, with proposals pushing toward the $1.50 trillion level. Capital is responding accordingly. Money is rotating out of speculative growth-dependent technology and flowing into assets tied to hard power, defense contractors, energy security, and strategic minerals that underpin military and industrial capacity. China has already moved decisively in this direction. By restricting exports of key materials such as silver, tungsten, and antimony, Beijing is tightening supply to external markets while securing those resources at home. This is not trade friction. It is strategic positioning. Control of materials that modern economies cannot function without is now being treated as a lever of state power, not a commercial decision. What we are witnessing is a regime change in the global system. Nations are prioritizing resilience, self-sufficiency, and spheres of influence over the cooperative frameworks that define the globalization era. In this environment, comparative advantage matters less than control of resources, of supply chains, and of the infrastructure required to defend them. The implication is straightforward but uncomfortable. The investment strategies that thrived over the last 2 decades were built on stability, cheap capital, and expanding global integration. Those conditions are fading. As the world reverts to a more fragmented and confrontational structure, tangible assets, resources, infrastructure, and the means to secure them are regaining their historical role as the ultimate store of value in an increasingly unstable system. The bitter irony of today's silver shortage is that it was engineered by the same financial system that spent decades suppressing its price. When silver was treated as abundant and cheap, capital followed the signal. Exploration budgets were cut, development was delayed, and new projects were abandoned. For nearly 10 years, the industry stopped building future supply. That decision cannot be undone quickly. Mining is not software. You cannot flip a switch and scale output overnight. From discovery to first production, a new silver mine typically takes a decade or more. Even if a major deposit were identified today, meaningful supply would not reach the market until well into the 2030s. At the same time, the quality of existing deposits is deteriorating. Head grades are falling, which means miners must process vastly more rock to extract the same amount of metal. Costs rise, efficiency falls, and production becomes increasingly fragile. This is the definition of a supply cliff. Mine output is stagnating or declining just as demand from solar manufacturing and next-generation batteries is accelerating sharply. And because most silver is produced as a byproduct of other metals, higher silver prices alone do not guarantee higher supply. If lead, zinc, or gold economics do not justify expansion, silver production remains constrained regardless of price. The result is a zero-sum environment. When silver becomes essential to keep factories operating, industrial buyers will not negotiate. They will outbid. Jewelry demand and small investors are not competing on equal footing with multinational manufacturers, whose survival depends on securing metal at any cost. That is how markets behave when a material shifts from discretionary to critical. Silver is crossing that threshold. It is moving from a precious metal traded for adornment or savings into a strategic resource accumulated by states and corporations with long time horizons. Once that transition is complete, pricing resets permanently. The era of cheap silver, priced like a casual expense rather than a strategic input, is ending. And history suggests that when supply cliffs become visible, the window to act closes faster than most expect. When history, technology, and geopolitics begin to move in the same direction, the outcome is rarely subtle. What we are witnessing now is not a market phase or a cyclical adjustment. It is a structural transformation of the financial world itself. A 180-year-old national trauma continues to shape China's gold strategy. Japan's fight for currency survival is sending shockwaves through the U.S. Treasury market. And a growing industrial famine for silver is forcing the world's most powerful technology companies into direct competition for finite physical supply. These events are not isolated. They are connected signals of a system crossing a threshold. The rules are shifting. Value is migrating away from abstraction and back toward reality. From digits on a screen to assets that must be mined, refined, stored, and defended. From paper promises that depend on confidence to tangible materials that function regardless of narrative. When the quoted spot price no longer matches the availability inside the vault, pricing has lost its authority. When allies are compelled to liquidate your currency to protect themselves, stability becomes a marketing term rather than a condition. We are entering an era where conductivity is not just a technical requirement, it is economic lifeblood. Where control over money still determines fate, but money itself is being redefined by what cannot be frozen, printed, or defaulted on. China remembers exactly what happens when wealth exists only at another power's discretion. The technology giants understand that innovation collapses instantly without raw materials. Both are acting accordingly. This raises a question that can no longer be avoided. In a world where systems are fragmenting and speed is accelerating, what actually holds value when confidence fails? Is this simply turbulence within a familiar order, or the early stages of something fundamentally different? Because when history reasserts itself, it rarely announces the turning point. It reveals it through behavior. And the behavior today is unmistakable. Capital is moving toward what can be held, secured, and relied upon when promises no longer suffice. The only remaining question is whether that reality is recognized early, or only after the window is closed.